All right, looks like we are live. Hello, everyone, and thank you for joining today's webinar with IEX Cloud. My name is Adam Wozni, and I am a community manager at IEX Cloud, and I will be your host for today's fantastic webinar event. Jumping right into things, because we have a lot to cover today, I'm going to have a very short disclaimer. We're going to do some housekeeping on kind of how to ask and answer questions on the Zoom webinar format. We'll do a quick poll, learning a little bit more about you so we can kind of have David and Tim prepare for some of the questions that you might be asking later on in today's event. We'll jump right into the interview with David and Tim, and then we'll try to leave some time towards the end of today's call to leave some questions for you guys to kind of ask David and Tim that maybe you've thought about as they're going through their conversation. So very brief disclaimer, the data and information presented in today's video is not investment advice. IEX Cloud Services and New Constructs makes no promises or guarantees herein regarding results from particular products and services, and neither the information nor any opinion expressed today constitutes a solicitation or offer to buy or sell any securities or provide any investment advice or service. That's a mouthful. Now that we got that out of the way, we can jump into the fun stuff. So throughout today's presentation, I'm sure you guys are going to have a lot of questions. David and Tim are going to cover a lot of different topics. So as you're thinking of those questions, to do that, use the Q&A button in the Zoom webinar, and I will start to collect those. And then towards the end of the call, we'll try to get through as many as we can in today's webinar. And if not, we'll try to answer some via Twitter on IEX Cloud or New Constructs. But ask as many questions, and anything that comes up, feel free to put it in there. Cool. And before we get into this, we want to know a little bit more about you guys. So we're going to do a quick poll. So we'll take maybe 60 seconds, and I will launch it now. We'll take 60 seconds and we'll run through this poll, and then we'll jump into the webinar. Cool. About 30% of you have voted. Almost there. Oh, 50%. Excellent, a lot of good responses. Maybe 10 more seconds. All right, looks like we're just about there. So I'm going to end the poll, share some results. Cool. So it does look like a handful of folks are familiar with IEX Cloud. Thank you. A couple, about a quarter, are not. As for New Constructs, it is a pretty big majority. So David, you have a lot to cover today. As for your familiarity with XBRL, it's good that you don't know, because David and Tim are going to cover some of those things. And then the most important question is, how is your day going? A vast majority is having a pretty good day. A small 10% of you or 12% need a vacation. So the weekend's coming up. All right, so for the folks that are not familiar with IEX Cloud, I'm going to spend maybe 5 minutes or so just kind of quickly going over what IEX Cloud is before I hand it off to David and Tim. So for those of you that are unfamiliar, IEX Cloud actually formed in early 2019 out of IEX Group, which is best known for the exchange. There's a lot of great information on that side of the business. And to access that information, you just go to iextrading.com. But you guys here today are interested in IEX Cloud. So there we go. Traditionally, if you wanted to gain access to financial data, you would have to go to one or two or a handful of different providers that charge pretty substantial rates. Something I learned when I joined IEX Cloud. We do something different. We provide financial data to developers, investors, entrepreneurs, enterprise folks, startups, even students. Access to financial data through a series of what we call data creators. Basically, folks that provide slivers of data, high quality data that, if not just as good or not better than some of the data you get at some of the bigger providers, at a far substantially lower cost. Basically, we have kind of two folks, data creators that provide the data, and then folks like you that I'm guessing are listening to today's call, people that need access to that data to build projects, applications, websites, apps, anything that you would need financial data for, we kind of provide those things. And when we're talking about data, I'm talking about a lot of data, from stocks to corporate actions, cryptocurrency, Forex, fundamentals, which David and Tim will be covering some today, economic data, reference data. I mean, a lot of different data points, all through our simple API. But really, if you look at IEX Cloud, it's much more than just the API. I mean, that's kind of our bread and butter. But we do offer SSE streaming. We have a fantastic Excel plugin that we've built out that will gain access where we can pull data from IEX Cloud directly into an Excel spreadsheet for manipulation. We have a thing called Rules Engine, kind of like if this, then that statements for notifications in regards to your IEX Cloud account. And then we also offer something called IEX Cloud Gateway, which is a partnership we have with OpenFin to gain access to IEX Cloud data through their services. So that's the high level of IEX Cloud. As I mentioned, there's a lot of great resources, YouTube videos, blog posts. You can get access to a lot of that through our website at iexcloud.io. But today, you guys are here to hear from David and Tim. So for quick introductions, David is a Wall Street veteran and a corporate finance expert. He specializes in reverse accounting distortions on the underlying economics of business performance and stock valuation. Pretty cool. He was a member of FASB's Investor Advisory Committee from 2013 to 2017, and he's the author of Modern Tools for Valuation. So that's David. Tim Baker is the head of IEX Cloud and a chartered financial analyst, CFA. With over 30 years of experience, he has previously worked for Rolls Royce, UBS, Thomson Reuters, and Refinitiv. So with that, I'd like to hand the mic over to Tim Baker and David Traynor. Tim, take it away.
Great, thanks, Adam. Can you see my screen okay? I just took control. Great. Really excited about this session and great to have you, David. When I think of the financial data industry, I think of it in terms of almost like a manufacturing process where we start from raw materials in one end and insights and value coming out of the other end. And IEX Cloud, I think you just heard, has built a platform to connect data creators with consumers of the data. Today, we're focusing on just one content set. It's a really important one very close to my heart. We could have chosen insider data, short interest, real-time prices coming from exchanges. They all follow a similar pattern. They require a lot of data wrangling, cleaning, and adjustments before they're really fit for purpose. And we work with world-class experts like David in these specific areas to make sure the data is coming out clean. Obviously, garbage in, garbage out. It's going to affect your investment returns if you don't have high-quality data in the first place. So today, we're going to focus on company financial data, the bread and butter of any fundamentally driven investor. And David really is a recognized authority in the space. And we're going to talk about three things, really: the disclosure process, how companies file to the SEC, what that data kind of looks like, what are some of the issues and trends in those disclosures, because there's been quite a lot of changes with things like Sarbanes-Oxley. And then we'll get into how New Constructs normalizes that data and then adjusts it and makes it really useful and comparable across companies, across industries and sectors. And then we'll look at some specific valuation metrics and adjustments that New Constructs has developed, along with some example companies. And we're going to finish by talking about everyone's favorite stock, which is GameStop, and how taking a fundamental view can really help you invest in those meme stocks. So David, we've known each other for many years. Can you remind me of how you got started in equity research and how this led you to launching New Constructs? What's your kind of motivation and what's your kind of overall philosophy when it comes to equity research and valuation?
Yeah, thanks, Tim. And just real quickly, I'm really proud to be working with IEX and IEX Cloud because I believe in their mission. And I think we're very much aligned in terms of democratizing access to good data and ultimately the truth around stocks and bonds and mostly fundamental analysis. My background is from Wall Street and I was at Credit Suisse during the tech bubble. They were the #1 tech banking firm, and I was there before, during, and after. And so I really saw like the implosion of the fidelity of and integrity of sell side analysis kind of happen, like in right in front of me, very early in my career. And I started in the business. People did the work to read 10Ks and 10Qs or annual reports and quarterly reports. They were shorter back then, 30, 40 pages. Now they're 200 to 2,000 pages. And I was kind of blown away, by the willingness for people to say things about companies in order to get a banking deal done. And really the lack of interest in doing kind of the diligence around profitability and valuation, because mostly it got in the way of getting deals done. And I've been raised in the business to kind of do that good work on the front end. And so kind of after going through all of that, I realized, look, there was a way for technology to make this happen, make research much more efficient. Going through a 200-page annual report is just not something that most humans want to do. There are some that love it, but even if you do love it, it's hard to do more than a few in a day. Yeah. And in order to keep up with what's going on, you need to do hundreds. And so I decided we should create a technology around doing this kind of diligence. And I saw that as a platform for democratizing access to the truth around fundamentals, because without going through the fine print in these very complex filings, you really don't know what's going on. And so that was my motivation, Tim.
And then even at the very kind of highest level, this slide kind of, I think, massively generalizes what you do, but it's a good lead into what we're going to talk about. Can you just kind of take us through, the very high level adjustments that you're making to just the earnings statement, and we'll come on to the other statements later.
Yeah, before I got to Wall Street, I'd come straight out of undergrad, and I got into the accounting business. And my first experience on an audit job was, oh, don't worry about that mistake we made. We'll fix that in the footnotes later. And I thought, okay, what are footnotes? And then my next job was executive compensation consulting, where I went to boards of directors and said, whatever you do, don't pay executives based on accounting earnings, because you can grow accounting earnings while running the business into the ground. And so I was really attracted.
Well, we saw that with Enron, right?
Correct. I mean, it was a perfect example of that. Yeah. And we've seen other many, WorldCom and multiple, the examples go on and on. And so I was just fascinated by profitability of businesses. It's just something that's something I've loved. And the big distinction we make on the slide here is that your traditional P&L is missing a lot of really core elements to understand the real profitability of the business. Accounting was never designed to actually provide the profitability of businesses. All right, it wasn't designed for that. It was designed to count. And honestly, accounting rules were designed for debt investors, not equity investors, which is why back in the turn of the century, you didn't even have to report option expense, because debt investors don't care about the cost of options. And so there's three big things we're doing for the economic P&L. The first one is hidden income and charges. That just means we're getting the income statement right. We're fixing it to account for the real underlying economics of the business. Most of that stuff is hidden in footnotes, and there's proof now from Harvard Business School, Ernst & Young, that nobody else in the world gets this data. The second thing we got to do to fix the income statement is fix the taxes, right? Because if the taxes have been determined based on an incorrect pre-tax profit because of all this noise in there, well, then those taxes are incorrect as well. So we fix those.
Right.
The last part to get to economic profit is to fix the balance sheet. And that's to take into account everything that's gone into getting the business to where it is today. Because as an investor, when you think about a company, you think about it the same way you think about your money manager, right? The money manager makes you 10 million bucks. Well, that's pretty good if you only gave him 20 million. But if you gave him 20 billion, that's not very good. So the amount of money it takes for the company to generate whatever money they make is important. And we spend a lot of time focusing on getting that right as well.
And we're going to get into a couple of examples, but not all companies are abusive when it comes to this stuff than others, right? There's a kind of, there's a wide range of different approaches that companies either have to take or have decided to take.
Yeah, fortunately, a lot of what we're going to talk about today has all been proven true by a very detailed study from Harvard Business School and MIT Sloan that effectively reveals the flaws in legacy fundamental data systems. And the answer to your question is about 20% of the company's numbers are off by about 20%, so 20/20. Wow. And that's independently proven, right? And the paper that those professors wrote is forthcoming in the Journal of Financial Economics, which means it has been approved and accepted by all the subject matter.
And that's all built on new constructs analysis, right?
Oh yeah, the paper is basically on new constructs because we're a disruption to the traditional way of doing things, which is to hire, a couple thousand people in an offshore location and do it all manually.
Yeah. Well, we're going to come on to how your factory works in a minute. I'm looking forward to that discussion. So let me just go to the next slide. So this is a couple of screenshots from the SEC website, and I've spent a lot of time on this website recently checking our as reported data, which is just basically a scrape of the data off the SEC. And as I mentioned, I see this as a supply chain of data. So this is really the raw material. This is where a lot of the data comes from. What are the kind of let's go back to basics. What are the filing requirements of companies today, and how's that evolved over the last 10 or 15 years? And how accurate is the data in the first place?
I think the companies have had to file quarterly. I don't think that's changed a lot, Tim. But the interesting thing that most people don't know, and we'll see if you know, how often is the SEC actually required to review the annual filings? By the way, they're not required to review the quarterly filings, but how often is the SEC required to make sure that companies get their annual report right? How often are they supposed to do that?
So I would have assumed that they would have some AI or ML that's adding up the balance sheet to make sure it balances every time.
And they don't. They're only required to check on these filings once every 3 years.
Wow.
And by the way, I've spent some time with the SEC, with the Senate Banking Committee, people in DC, around a report that we did that showed a very material number of companies whose balance sheets don't balance, whose income statements don't add up to the number that they print in the filing. So yeah, part of the problem is that nobody's looking at this stuff.
Yeah. I mean, I think I saw on the blog on your website, someone suggesting that the SEC should just take your system and put it right in the middle of their process, because I think, that would save everyone an awful lot of time. But until then, we're going to be relying on you more. So let me go on to the next slide. So this was I made this yesterday. I'm quite proud of it. So this is 3 screen captures, if you like, from the SEC website. It's IBM. Now, I read a Wall Street Journal article which said that pre-Sarbanes-Oxley, the 10K report, the annual report, was on average less than 30,000 words. Post-Sarbox, GE's 10K ballooned to 250 pages and over 100,000 words. And this slide is a high-level summary of IBM's 10K taken from the SEC website. And I didn't count them. I think there's over 100 different red sections, which are the footnotes to the tables. And the tables are essentially explanations of line items from the P&L and the cash flow statement. And that box there is just one table. That's the table of the assumptions that go into the calculation of the unfunded pension liability. So this is a long way of asking the question, what do you do about the footnotes? How do you what are the big things that you're looking at in those footnotes? And we'll come on to the factory on the next slide and your process, but just give us a sense for some of the things that you're looking for.
Well, you're right to focus on the footnotes, Tim, and we've been talking about this for a long time. Of course, so we want to make sure we emphasize that the footnotes, are really where the action is. And the footnotes is really where, IEX Cloud is giving its clients an advantage, because part of what the Harvard and MIT professors prove is that the market in general is not impounding the impact of these footnotes, which again, about 20% of the time is having a 20% impact on earnings. And so we look at I think I gave you a slide. We got 30 things that we're looking at in the footnotes. Pensions, stock-based compensation, a variety of unusual gains and losses around restructuring, around derivatives, around legal expenses, around inventory obsolescence. There's off-balance sheet financing and debt. There's foreign currency exchange. There's deferred compensation tricks that companies can use to put assets here or there. There's restricted cash. I think, one of the reasons we're, as far as I know, the only firm that does this work is that the amount of accounting nerdery required to understand this stuff is kind of off the charts.
Yeah.
But But even that doesn't do you any good, because if you don't understand the underlying economic consequence of the accounting data, which is a completely different part of the brain, it doesn't matter how much accounting understanding you have. That was my experience when I worked with the Financial Accounting Standards Board. They were great about the accounting, but they didn't understand what investors needed to know. And so a big part of the value add, and they spend a lot of time on this in the paper I mentioned, is that we take all this accounting data and we categorize it according to its underlying economic meaning. And that's kind of in many ways the very unique value add that New Constructs brings to the marketplace that's never been done before.
Right. And if you look, I know it's a little bit small, but there's, for example, a section in the report on the SEC that is the disclosure of the accounting policy that the company's chosen, which suggests that it's not much of a standard, right? You know, if people can kind of pick and choose. And, you know, when I was looking at our as reported financials, even things like revenues. So the revenues, the tag for revenues for one company, I think it was Microsoft, and the tag for another company, IBM, that you would think they're going to have the same tag for revenues, right? No, they don't. They've chosen a slightly different flavor. I think one was revenues including taxes. And then cost of sales. There's cost of sales, there's cost of revenues. You'd think they're the same thing, but they've chosen two different tags. So consuming that as reported data, even at the kind of the metadata level, requires a lot of logic, and we'll come on to that in the next slides. So that brings me on nicely to the next part of the supply chain, which is the factory, right? So this is your factory. I'd love to kind of hear you talk a little bit about, you know, your use of AI, machine learning, and making this really work. Because as you say, you don't have 2,000 people in, you know, an offshore location. You have what, 20, 30 people, but you're all specialists who are operating this factory. So David, just take us kind of through this process.
Yeah, you know, look, I spent a lot of time reading. This is my favorite prop, right? Tim, you saw this. You used to bring this to your office all the time.
Yeah.
You want to do this, right? So I spent more than my fair share of time of reading these things. And I began to see a pattern emerge that while there's a lot of variation, like what you just made, the comparison between IBM and Microsoft, it's not an infinite amount of variation. And if someone's willing to do the work to painstakingly kind of categorize all the different variations into appropriate buckets, right? So, you know, that example you gave with IBM and Microsoft is a perfect example of how the accounting names can be different, but the underlying economic consequence or meaning is the same. So you really kind of need to understand both of those things. And if someone was willing to go do that with scale, then we can create, you know, an entirely new normalized database for people. And this wasn't my idea. It's not original. Al Rappaport wrote about it back in early 1980s in Creating Shareholder Value. And that's kind of where I first sort of realized, hey, this is a big opportunity. And so we take the filings and we can take it from the SEC, we can take it from a private company, we can take it from anyone. And you know what we've done over the last 20 years is not fancy. It's not magic. I honestly don't believe in machine learning and you know, close encounters of the third kind or all that kind of stuff. AI, the machines are only as good as what the humans teach them.
Yep.
Machines' value add is that they do exactly what you say every single time without vacation, without a break, right? Which means if you get it wrong, you get it really wrong. And so really, I think what is unique is that, you know, we built, when I started New Constructs, the first thing we did was build we didn't know it at the time, but it was a machine learning or natural language markup tool, which made going through these long filings much faster, more efficient, and tracked every single time an analyst said, oh, cost of goods sold goes into this cost of goods sold bucket. Cost of sales goes in the same bucket. It means the same thing, different name, goes in the same bucket. And we've done that millions of times now so that the machine can come along and say, oh, I've seen this before, I know where it goes. Because an expert human has told me that that's what we can do.
And does that work through time for a single company as well? So, you know, companies, I would imagine, tend to use the same tag period to period.
No, they don't.
They don't. Okay, so they
no, not even in the Q and the K is often different. The quarterly report and the K is often different. And sometimes the XBRL version is altogether different, right? You know, and it's funny. I remember, you know, 4 or 5 years after I started New Constructs, they decided to start XBRL. And I was immediately pretty skeptical because having read these filings and seen the trouble to which companies go to obfuscate performance, because by the way, it'd be a whole lot easier if they didn't change, they use the same income statement terminology in the quarterly report as they do the annual report, right? It's easier to do that, right? Why would you make your accountant do it 2 different ways, right? So it's pretty clear to me that
didn't they allow, was it 2013? They allowed companies to basically extend the standard to fit the way that they wanted to report the numbers.
That was my point. That's kind of the point I'm getting to, is that I was skeptical about like this whole XBRL thing. Like, look, if they're already obfuscating performance, then why do we believe we can rely on corporate America to adopt a standardized language for financial reporting that's going to let someone basically do what New Constructs has done, and that's reverse engineer all the obfuscation? They're not going to do it, which is why you see the explosion in tags, right? You know, the digital needles in a digital haystack as opposed to paper needles in a paper haystack. And you know, they get the tags wrong. They make up tags because at the end of the day, the companies don't want what we've done to happen, because look, like any kind of, you know, any kind of salesman, the less information you can get away with giving in order to get a sale done, the better off you are. And there's an enormous amount of money to be made in selling stock.
I think it's also means we don't have a level playing field, because there are some very sophisticated investors out there that are like you. They've developed systems to be able to see behind the data and do real cash flow analysis and real value, and better invest in the stocks that are going to win long term. And this is why I'm delighted that you're on our platform, because our mission very much is to level that playing field. Anyway, carry on working us through that process. So you're taking data out of XBRL, but you're doing it. You're getting data from other places, right? Obviously, the footnotes is a big piece.
Yeah, and you know, we do take data from XBRL where we can, where it works, but it doesn't work most of the time. But you know, the way I put it to my team is, if we can get confirmation electronically that what we've parsed on our side is correct, well, let's take that where we can.
And by the way, there is some really interesting stuff. Again, I'm a little bit in like you are, David. I like looking at the numbers, and you can go into some statements on you know, in the XBRL. You can find, for an airline, you can find you know, passenger seat data, for example. Now, not all the airlines decide to populate that. I wish they did, because it's quite hard data to get. And as an ex-sell side analyst, I would have been going through that filing as well, but I would have been having to do all the standardization that you're doing in your platform on top of that.
Yeah, we wanted to create automation around the process of it, that a smart analyst like you, Tim, would engage in. And you know, the only way to do that is with a lot of repetition, right? You just got to do it over and over so the machine can ultimately figure it out on its own. So you know, we take in the filing, and this is an oversimplification, financial statements and notes. There's also the MD&A. We get a significant amount of data from there, which XBRL actually does not cover.
So that's really unstructured. So that's the management commenting on the numbers, right?
Management discussion and analysis. There's a ton of information in there, especially around pro forma numbers. And we collect that. And so what it goes through is it hits the technology, and the technology sort of parses as much as it possibly can. And sometimes that's everything. And sometimes it has questions. And if it's not sure and we can't validate it, well, then it goes to a human.
Right.
The human comes through and finally validates it. And I think, you know, we don't get into a lot of detail on the left third of this slide here, but, you know, I think it's important to understand, you know, the unique things that we're doing around the data classification. That's the normalization you talked about, Tim, right? If you're going to get data from a traditional or legacy data provider or from XBRL, you're going to get 3 different names for revenue. Yeah. You're not going to be able to compare financials and industrials. Well, we do all of that because our system, as you saw when you first looked at our taxonomy, right? The difference in the taxonomy or the ontology of New Constructs data is that it's based on the economics of businesses.
Yep.
And the economics of businesses are comparable by company to company,
of course they are.
Sector, region of the world to region of the world. Economics, right? Everybody's trying to do the same thing. Generate as much cash flow as possible based on as little capital in the business as possible. And that's the way our system is built. And that requires a unique combination of economic, finance, and accounting expertise. But that's sort of the architecture of the system. And then all this goes into a database upon which we then build models and reports and analytics. And because the database is built in a very specific way, we kind of have an infinite amount of ability to generate reports and models. So like, for example, I think we send you guys 10,000 new reports a day on stocks, ETFs, and mutual funds. We just added another 2,800 reports a day on credit ratings.
Yeah, right? Brilliant.
And so we can provide.
And you can apply a highly standardized set of valuation metrics because you've normalized and cleaned up and adjusted the data. So again, you've got clean in, and then you can apply these things on a much more comparable basis.
Yes, that's exactly. So what we send you guys is the raw data so that people can do whatever they want to do with it.
Yeah, so we get a feed from this database, basically, right? And
Correct.
Then we also have reports which come out of the back end.
That's right. New Contracts has a website, and we have a lot of clients that use that, and you have tracking tools and models.
I use it. It's a great website, David.
Thank you.
Really good.
Okay. The other key aspect on all of this, and this is the only reason that Harvard and MIT and consultants at Ernst & Young could write a paper vouching for the superiority of our data. This model that you're seeing on the page right now represents sort of a vertically integrated supply chain for creating research, right? We're the only firm that mines our own data and then produces research on it. I think that makes us smart about what data matters. But most importantly, it provides click-through transparency for every analytical number we have back to the source. Yeah. Every calculation we can take you back to the source. And that was critical for Ernst & Young and Harvard and MIT and the Journal of Financial Economics to prove to subject matter experts around the world that the data was better. Because they did.
Look, if any analyst that's going to rely on your normalization is going to want to spot check that and see that, go back into the supply chain. Well, we're going to see that on the next slide. This is our first sample company. I'm not saying anything good or bad about GE. It's just looked like a good use case. So this is literally ripped from one of your reports. Talk to us about, and I can click on any of these and it will go to the audit trail as well, David. So maybe pick on one or two of these and just kind of explain what's behind the number, and then explain this chart on the right hand side.
Yeah, this is an example of kind of a lot of the research that we do. And you're right, Tim. Every one of these hyperlinks on the far left there takes you to the spot in the filing where the data comes from. And like I love to say to people all the time, like with our competitors or whatever, like, look, if you've done the work, then don't you want to show it off, right? Why not be transparent, right? What's wrong with transparency? And you don't get this from any other data provider, and that's in the paper too. I mean, the professors, S&P knew that we were doing this work, right? And they couldn't vouch against it. So. Right. So let's just start at the top. 12.5 billion in purchases and sales of business interests reported on the income statement. Basically, what we're talking about is non-recurring gains and losses that are put into the income statement. So when you look at a business, you want to understand how the profitability of the business based on its core operations is going to exist over time. So to the extent that they've done some purchases and sales, those are unusual. They don't do that every year, except for some companies like certain REITs. They're in the business of gain on sale of property all the time. And that would be operating. But for purposes of GE, it's not. And what most people don't know is Jack Welch used this trick for years to manage earnings. But we will take out, you can see here that specific item, as you can get from only page 93 of the 10K. It's a big number, 12.5 billion.
Let's go back. What else should we pick?
Any one of these. How about 2.4 billion?
Yeah, that was the one that stood out to me. That's a nice lumpy number.
Yep, non-operating benefit costs. So again, a non-operating item on the income statement that you're not going to find except unless you go to this additional. Is that pension or is that somewhere else? Sorry, that's a reported item. So you can see here this is the picture you're showing is actually a picture from one of our models. Okay. You can actually click through, and this is under the reported other non-operating. So this is reported, which means on the income statement. Oh, it's on the income statement, right? Okay. And we always distinguish between what's reported and what's hidden because we think that's only fair. But this is the non-operating benefit costs that by virtue of being non-operating, should be included in your operating earnings.
Yeah, and if you look at this number, it's a big number every year, right?
Yeah.
Kind of smells like it's operating.
Yeah, that's a very good it's a very good point. You know, that there's a lot of recurring, non-recurring items.
Yeah.
And there's a philosophical discussion.
Exceptional items that aren't really that out of the ordinary.
That's right. That's right.
What's another big one? That's pretty big. 1.7. Let's do one more. Yeah. We could do this all day. Okay, goodwill, one of my favorites.
Goodwill impairment, you know, it's a big write-off that they took in, you know, and it's basically they're saying we overpaid for an acquisition, and now we're just going to pretend like it's.
Looks like they might, you know, quite often overpay for acquisitions.
Yeah. Yeah.
And as an analyst, I'm going, what was that 22? And are they that $22 billion, right?
Yes.
What was that? And are they working on any other deals? I think they're probably doing less deals these days.
Yeah, no, we wrote a piece, you can see it on our website. We predicted the demise of GE about a year before it blew up, because we saw that there was all this overpayment and that their return on capital, the cash flow relative to the capital in the business, was way bad, and the stock was trading at a significant premium to that. And so we saw a lot of this coming because of the work we were doing. I
think that. I'm just going to ask a side question here, because one thing you're not doing, and correct me if I'm wrong, is generating a forecast, right? But I think what you've just said is that actually, if you look at even the historic data and look for those patterns and put the data in a certain form, it is indicative of the future performance of the company. Is that fair to say?
Yeah, you know, you're right. We're not in the business of trying to predict the future, because we think that Mr. Market does that for us, right? Yeah. So every day when Mr. or Mrs. Market gives us a stock price, that stock represents the present value of future cash flows available to the owner of that stock. And so our approach to valuation is to say, well, look, I don't need to be in the business of predicting the future. The market's predicted the future. What we do is reverse engineer what the cash flows have to be to justify that stock price. And in some situations, like say, for example, GM, you find that the market is implying that GM's profits will permanently decline. The level of profits today is higher than the profits needed to justify the stock price.
Right.
In other situations, like a Tesla, right, the profits in the future are extraordinarily greater than what the profits currently are. So great that they imply actually that Tesla has to be 150% of the entire electric vehicle market. And so, you know, we call that expectations investing. And that's a term I got.
Great sanity check though, isn't it? Can this company really achieve a compound average growth rate of X for the next 10 years? Sometimes you make the call, right? And you go, yeah, because they've got first move advantage, or it's a new market. But I don't think a lot of investors do back out the implied growth as much as they should do. And we've been in this incredible momentum market for the last few years. And I think it's a great thing to look at, because it's going to be those companies that don't deliver on that implied growth rate, which were the ones they're going to be the ones that start to correct first. And maybe we've seen some of that in the last few weeks. So just take us through that chart on the right, and then we'll go on to the next slide, David.
Yeah, that's just a comparison of the core earnings for GE to the GAAP net income. Core earnings is the clean measure of earnings that the professors from Harvard and MIT prove is better than anything you can get from S&P or IBIS, Refinitiv's IBIS, from analyst estimates, because it's the only number that's been cleaned of distortions, unusual gains and losses. And the paper basically focuses on that whole point, that these distortions, what the paper calls total adjustments, something that you can only get from new constructs. The legacy systems do not adjust for these. They're not scrubbed for these. And so the core earnings number is better. And this chart just shows how you're getting a complete disconnect between core earnings.
Yeah, so you look at the GAAP numbers, and you go, hey, GE are turning it around. You're saying quite the opposite. Now, I think some of the charts that I see that you do, the GAAP and core track quite closely, and then they diverge. It's almost like they threw something in, and I think your methodology is great at spotting those new things. You know, maybe it's an acquisition that's gone wrong, a change in accounting policy. So that's one of the things I've observed, but this one is really kind of stark. And actually, if you look at GE share price and the dividends they pay, it's not been a good performer for last 2 or 3 years. Okay, so let's kind of wrap this bit up. This gets a little bit kind of techie, but it'd be great if you can kind of just walk us through those key performance metrics that come out of the end of the factory, right? What are those metrics and the valuation metrics that you can then calculate to determine whether the stock is potentially over or undervalued, or as you say, is pricing it too much in too much growth?
Yeah, I'll be quick here because this gets pretty nerdy, but it goes back to what I said around there's a difference between accounting and finance, right? Accounting results like net income, they're not really designed for equity investors. They're not designed for investors. They're building blocks. And what you see here between NOPAT invested capital and weighted average cost of capital, those are the economics of the business. That's what we use all this accounting data to create, right? So think about the NOPAT, net operating profit after tax. That's your cleaned up income statement. Invested capital is your cleaned up balance sheet. And when you have NOPAT and invested capital, well, then you can measure return on invested capital with integrity, right? Ernst & Young wrote a report proving that our measure of return on invested capital is best in the business. And then when you have weighted average cost of capital, then you can do return on capital minus cost of capital, which is economic earnings, EVA, economic profit, whatever you want to call it. We don't have a proprietary name for that because we don't believe the formula is proprietary. We think the superior data is proprietary, and that's the way we run with that. Free cash flow, that's your NOPAT minus the change in invested capital. And so the key thing is that you have to recombine all this accounting data into economic statements that represent the economics of the business. Once you have the economic statements in place, and that's your NOPAT, invested capital, and your WACC, then you can do all the cool calculations. The list of calculations at the bottom of the page, that's just the tip of the iceberg. There's 1,000 different calculations you can do.
So let's take the economic profit one. Can you take price instead of a PE ratio? You could have a price on economic profit ratio.
Absolutely, absolutely. It's gonna just be a much better tell on what the underlying profitability of the business is.
And that free cash flow number, is that free cash flow to the enterprise or is it just to the shareholders? That's
free cash flow to the enterprise. We also have a free cash flow to equity holders that we can calculate. Again, these are focused on the fundamentals. And to answer one of the questions from the audience, does new constructs analysis help more with growth or value? And the answer is value. And that's not to say that fundamentals should be 100% of the process, but we just don't think it should be zero either, right? Think about new constructs. If you're a growth and momentum person, just think about, this is a sanity check, as an overlay to make sure you understand just how much risk you're taking.
Yeah, we did a webinar a few weeks ago, and I talked about value versus growth, and we talked about some of the meme stocks, which is the next thing we're going to cover. And to me, it's a mosaic, right? You should not just use fundamental analysis and not look at whether there's a short squeeze on or there's some kind of momentum behind the stock, because you'll just end up catching that falling sword. So you need to kind of understand how the stock trades. You need to understand and appreciate technical analysis and momentum and all those other things alongside fundamentals. And periodically, I think the fundamentals will win, and periodically momentum will win. But I don't think you should just trade on one. And we've seen this rotation in the market in the last 6 months, where growth has given up, large cap has given up, tech has given up to small cap value. I had an analyst I worked with at UBS, and he spent all his time, he was a quant, looking at detecting when there was a shift in investment style. And there's, I always think everything kind of goes back to the average in the end. So things get ahead of themselves and they'll retrace. And I think that's the case when it comes to value and growth. You just need to be able to understand those. And I think, again, a lot of your data forms the basis of understanding where we are in that kind of style world. So let's talk about the meme stocks. Sorry?
Yeah, it's a great segue. Great segue, Tim, because I think you're absolutely right. Everything matters. Like one of our biggest and smartest clients, and these guys, billions is a small number for them. when I asked, so what's your strategy? This is after I was running a hedge fund for a while, and we were focused on what we do. And and the answer was, every strategy is our strategy, right? It's about timing. Well, what matters more right now? And that gets to something I think is really important between IEX Cloud and new constructs. And that is that, and this slide is my favorite for making this point. The biggest thing that I think this whole meme stock and Wall Street bets reveals is that there's a huge void in the marketplace for reliable fundamental research for your average investor.
Right.
Wall Street is not reliable, right? They're in the business of selling you stock. So they're not really going to give you something you can rely on. You can't get reliable fundamentals, which is why I think we're seeing people go so nuts on the momentum and growth side, because that's all they got. To a person with a hammer, everything looks like a nail.
Yep. I picked this this slide as well. Can you just kind of take us through what's here? Because this looks like, a very clear flaw that you've created. But explain what's going on in this slide, David.
The really interesting thing about GameStop is that it was on our focus list over a year ago. We identified it as a private equity candidate because it was just making more money than what the valuation was.
So it was a real value stock then. It was cheap.
It was a real value stock, and we said for a long time we thought that the retail apocalypse narrative was overplayed. Like, not every brick and mortar company was going to die. And by the way, Amazon is proving that by virtue of investing in a big brick and mortar company with Whole Foods, right?
Yep.
It's a hybrid model, the omni-channel model that Target is crushing it on, right? That is working. Regardless, what we found is that we sat on that position for a long time and didn't do much for us. Well, beginning of the year, down in mid-January, it started to really take off. We're like, okay, good. We're ready to get out of this. We got a good game. Now, we ended up not selling it for a few more days and, of course, got even bigger gains. But the point here is, look, a company, stock can be good, but at certain points, it is no longer a good stock, even if it's a good company.
Exactly.
And the version of this on my website, has the inside the box, it's red, because that's like danger. And what I love about this is that what I'm trying to convey to people is that, this is a fundamental radar opportunity to just understand that when GameStop gets up above $45 a share, you need to think about getting out. Now, that seems silly if it goes all the way to 350. I get it. But
how many people sold at 350? Probably, my experience, a few will have ridden it all the way back down.
That's right. And the point is, you never know. It's so arbitrary when it's going to turn. And we've seen, it came way back down. It's kind of come back up and it's going back down again. Look, play that game as much as you want, but do so with a little fundamental angel on your shoulder that's telling you.
I completely agree. I think be disciplined, and, reversion to the mean is really powerful, but you've got to know what the mean is, right? You've got to know what you're reverting to. I think this is a great example of, it gives you something, it gives you a baseline and a reference point. I think GameStop's earnings call was yesterday. I've not listened to it yet, but very timely conversation.
They missed, and the stock's getting crushed. I think it's down. It was down to 20%. 20% today at one point.
Yeah, because the fundamentals haven't changed, right? The stock goes up and down, doesn't really change the underlying fundamentals of the business. So this is taken from your website, but it's also in those reports as well, David. So this is GameStop as well. Just give us a very quick tell us how to read this.
Yep, this is our equity rating. You can see there's a button there to switch to the credit rating if you want, but if you go from left to right, you're going to get a red is bad and green is good signal for the overall risk reward for that stock. And by the way, our debt rating looks very similar to this chiclet here.
Right.
And then in the next box, you've got quality of earnings. And that's where we're doing all the work on the balance sheet and income statement to understand the real underlying economics of the business. Economic versus reported EPS is where we compare the real earnings to what the company says they're doing. Right. So looking for disconnects there is a big part of what we do. And then return on invested capital, or ROIC, one of my favorite measures, metrics of all time. And that's that economic measure of how much cash flow the business generates relative to how much capital goes into it. And we look at that as
they're destroying value, basically.
Correct. I mean, it's negative 4%, right? So for every dollar they've been given, they're losing 4 cents. It's not good. And then on the right side, the valuation section is all about kind of getting a sense for how much of the stock price is dependent upon future cash flows compared to past cash flows. And so moving from left to right, we've got three different things here: free cash flow yield, price to economic book value as opposed to accounting book value. That's the price to economic book value. And then the market implied growth appreciation period. Free cash flow yield is pretty straightforward. It's positive because guess what? GameStop is selling off their balance sheet. We see that a lot with companies that are going bankrupt or out of business. Their free cash flow is going to look good because they're like selling off stores and selling off the business. The price to economic book value here is really interesting because it's negative. Economic book value is like a cash flow version of book value. So it looks at the perpetuity value of your net operating profit after tax. So just think about net operating profit after tax divided by weighted average cost of capital.
Yep.
Plus cash minus debt, all that. It's negative for GameStop, right? For the same reason ROIC is negative, because the company's not generating cash flow.
Yeah. So
more than 100% of the stock price is based on future cash flows. They're not making money today. So the stock price has got to be based on just, them going from unprofitable to profitable, and then, at $194 in this situation, super profitable.
Yeah.
And the market implied gap is based on our reverse discounted cash flow model, which is, this expectations quantification thing I talked about, where we model out an extrapolation of past performance. Now with GameStop, we have to assume some improvement, otherwise we never get to a positive share price. But we extrapolate what consensus has for the company and what the company's done in the past, and we see how far out in the future we have to assume growth in profits for the DCF model to generate a price equal to the current stock price. And for GameStop,
great. And is that this greater than 100 years?
Correct. The model only goes out for 100 years. You've got
quite a long holding period there.
That's right. The model only goes out for 100 years. And again, this is not how long you should own the stock. This is how long Mr. Market is saying the company's going to grow profits.
Right.
And as you pointed a second ago, you look below, when we look at the sector ETF for GameStop, it only needs 32 years combined for those companies to grow profits. The S&P, only 23 years. Right. Small cap stocks are at 40 years. So this is a great, very, very sound, objective mathematical way to get a handle on valuation. Obviously, you want to buy stocks where the market implied growth appreciation period or gap is very low. Yeah. You want to buy low expectations and sell high expectations.
Great. Now, last slide, because I do want to field as many questions as we can, and I can run over a little bit. Maybe you can, David. So just a little reminder of where you can get this data from. So as we mentioned, IEX Cloud is taking a feed of your standardized data. I use that data a lot. I've built some really useful templates that I use to invest with, and we put those on the site so people can get access to those. We also have the SEC filings, and we have the as reported data if you want to do all this work yourself. And then we also have your reports as well, which are in our premium corpus. And if anyone on the call wants to take a look at those, we have a promo this month, so you've got about a week. And David's kindly agreed to allow those reports to be available free of charge, so you can take a look at them. So if any of you are looking to buy or sell a stock for free, sign up to IEX Cloud, pull down the report and take a look. It might help you make a better call. And then on the right-hand side is the new construct site. And again, I use this myself. It's probably a bit more for the sophisticated investor. You've got DCFs, you've got the financials, which are the same as the ones we have, but you've also got all of the adjustments and access to that audit trail. And I think the best part of the site personally is the access to education and the research, because that's a real, for anyone who wants to understand more about this stuff, there's a lot of information there, webinars, videos, tutorials. And even if you're a momentum investor, I encourage people to take a look at the site and learn a few new tricks. So Adam, I've not been looking at the questions. Do you want to kind of give us the questions?
Yeah, absolutely. There's been a handful that have been popping in, and I've actually, David's multitasking. He's actually answering some of the questions live as he's responding. So he's definitely on point. But there are a couple that maybe we can kind of just throw up there. I think they're just generally related to the tools provided. So first one that popped up early on was, do you provide EPS estimates for years ahead? I'm assuming like forward-looking EPS estimates.
We do not. I spent some time explaining how we look at valuation. We think the EPS numbers that come from the street, those aren't really reliable. The Harvard and MIT paper prove that's the case. And so we provide an adjusted core earnings number that we look at historically. We don't extrapolate that in the future right now. We have some partners that do that, some quant and hedge fund partners that actually project our core earnings number in order to get how much distortion is in the current analyst earnings number. Right. That's a very attractive hedge fund trading technique.
Yeah, I would say that we do have estimates on the platform. Right now, they're for personal use only. If you're a platform or fintech and you want to redistribute them, give us a call. We can help set that up. I agree, David. I think it's really useful if you want to understand what's priced into a stock, look at that consensus number and then go, does this really make sense? And I think, again, combining that estimate with the implied growth rate in the current price is a really useful thing to look at.
Cool. This one's around tools. So Jan asked, what role does data visualization play in your analysis? Any favorite tools or technologies?
We love the data visualization tools. We've been toying with a few different software platforms, and it's a big part of what we do. Great question, because we are collecting so much data, and doing this all in Excel and SQL is really onerous and time-consuming. And so we are implementing using some of these new platforms to make that process a lot easier. And I don't really want to endorse any one, but I do think that they're very valuable, and I think they're kind of like machine learning and the parsing tools, technologies that we've created. Like, you need the machines to do some of this stuff for you. You need to teach them to do it right. And one of the things machines need to do also is just start to organize data in certain ways that we know we want to look at it every time, so we don't have to recreate the wheel every time.
I'm going to take that last question, Adam. Can new constructs data be redistributed? So we've licensed the core data from David and new constructs so that if you're a fintech and you want to put it on your site, you can display it. You can do calculations on it. You can send those out to your customers. The only thing that we don't allow you to do is to redistribute the data through an API. But as most of you know, our telemetry will keep track of usage, and that's how we pay new constructs and David. So yes, you can what we call redisplay. So if you want to build your own analytics, or if you just want to show a really clean set of financial statements, you can put those on your app or your website.
Yeah, you can't resell it though.
You can't resell it.
Yeah, definitely cannot.
You can't redistribute it as an API.
Cool. So Aaron actually has some really positive things to say about IEX and new constructs. So thank you, Aaron. And his question is just around like most common types of data that you're seeing be coming in as requests. Do you have kind of like, what are some things that people are looking for, like in terms of data that's most commonly requested from kind of both your sources?
We, in general, for us, it's the ratings. We have a lot of partners on the rating side: debt ratings, equity ratings, ETF ratings, mutual fund ratings, and folks like that because it's a short and direct answer. Green is good and red is bad. And there's been an independent study by Indiana Kelley School of Business, proving that our rating system is superior to human analyst rating system. And I keep mentioning these independent studies because I figure it's better to know that someone else is saying it, not us, because of course we're going to say we do that. But yeah, no, our ratings are most popular.
Cool. And then there was something around the ratings actually. Do the ranges for the ratings change by sector?
Not really, but we do rankings within sectors. So we have a screening tool that allows you to go in and say, okay, I want to see the best stocks in this sector. We actually, every quarter, we publish the best sector ETFs and best sector mutual funds. So we're not dynamically sort of moving the goalposts for different sectors on the equity side. but we do allow ranking within those sectors. On the credit rating side, yes, the thresholds do change because the credit rating business is a little bit different, but the thresholds do change based on particular sectors. And that's all detailed in the methodology descriptions on the education section of our site.
Cool. So we're about at time, so I'm going to ask two more quick questions. One coming from the audience. Does New Constructs provide analysis for cryptos? They were asking more about your thoughts on Bitcoin and likelihood of correction, but maybe steering clear of that, we can just do you provide analysis for cryptocurrencies?
Not really. We did do a report recently on the Coinbase IPO. We've got a lot of coverage on that. What we found there is it's a great example of our valuation analysis, is that at $100 billion valuation, it implies that Coinbase's margin on exchange revenues would be 57 times higher than the margin that mature companies like ICE Data and NASDAQ earn on their exchange business. So we think it's a little overvalued. We think that it's able to earn these margins because it's in a nascent business where there's not been a lot of competition. And I think as the folks at IEX Cloud know that there's no way to get that much margin. You can't get away with trading or charging those kinds of fees and transaction costs in a mature industry. And so Coinbase is a little bit risky because its stock price is already baking in that they'll be able to achieve 57 times higher margins on a comparable amount of transaction volume.
Now, when you add a new company, I've noticed this, you go through the S1, which is the red herring or the initial filing. It looks like, David, you add those to your database as quickly as possible, right? So we're getting financials standardized pre-IPO. Correct.
We think it's really valuable. In fact,
really cool.
Honestly, I think we have some influence. I mean, we were the first to report on WeWork, and we called it the most ridiculous IPO of 2019, and that IPO got canceled. And we've noticed a very, very significant trend since then, that the time between the filing of the S1 and the IPO is greatly reduced. So sometimes we're not able to get to it before the IPO, and we don't have a chance to give investors a sense of the truth behind the numbers. When we do, we think it's meaningful. And honestly, I wonder whether or not Wall Street has made that window smaller so that there's not as much time for people.
Well, I think that should be a bit of a warning flag, right? It's a bit like companies that have a lot of disclosures and footnotes. Maybe that's a flag, because obviously they're trying to explain a lot of stuff.
Correct.
Last question, Adam.
Yes. So last question is one that I always ask at the end of most of the webinars that we put together. I usually ask around podcasts or books, but I think for this one, David, I'll ask you, what's a good book recommendation for folks that would like to maybe learn a little bit more about the space?
You mean investing or finance? Which were
kind of maybe more about the supply chain and financial data, like how this is all created, like how people can gain access, that type of stuff.
I don't know if there is a real book on this.
It's a business opportunity.
My next book, yes, is going to be on that. I think that's what's pretty cool about what we're doing here with you guys. This is super cutting edge. Nobody's talking about financial data supply chain. The legacy data providers don't want you to think about legacy data supply chain because they don't want you to know how the sausage is made, because then you'll start asking questions that they can't answer.
Right. Cool. So we're about at time. So what I want to do now is actually thank you guys for joining. I think we can continue this conversation on our Twitter pages. So if you have more questions for New Constructs or IEX Cloud, just feel free to go to our Twitter pages at IEX Cloud or at New Constructs. We're looking to do another one of these events in a month. So we will be sending off a feedback form to everyone that has attended this event. There are some questions that we didn't have time to get to in the Q&A forum. So I will do my best at documenting those and sending them off to David and Tim for responses and maybe even following up on Twitter. So definitely go to our Twitter pages and follow along with the conversation there. But other than that, I want to thank you guys for joining today. Thank you to all the attendees for joining. Thank you, David and Tim, for giving the presentation. And other than that, I would just like to say, see you at the next one.
Great.
Thanks for having me.
Thanks, David. Great to see you.
Great to be with you.
Thanks.
Take care, everybody.